Hi, I'm Ginger Chan, founder of WealthQuant. We act as financial tech strategists, and our work focuses on education, modeling, and strategic design, tying your income planning, investment considerations, and tax planning together into one holistic system instead of treating them as separate decisions. So, a little bit about myself. I am a licensed professional engineer with an engineering and quantitative background. Before founding WealthQuant, I designed and built solar and storage energy projects and worked extensively on energy and financial model and tax strategies. I was pretty much the person responsible for whether projects actually performed as expected once assumptions met reality. And that background is why I approach tax strategy the same way I approach engineering projects, by understanding the structure, the incentives, the risks, and the system level trade-offs. Just before we continue, some quick clarification. This session is for educational purposes only. Nothing discussed here is tax, legal, or investment advice. At WealthQuant, we do not provide tax or investment advice. We design and evaluate strategies. We perform modeling, analysis, and we coordinate with the proper licensed professionals such as CPAs and attorneys to make sure that everything's verified for execution. One important framing point before we dive in is that solar tax strategy is just one of the many tax strategies that we help people with. We're focusing on it in this episode because it clearly illustrates how tax incentives, financial modeling, and structure work together, not because it's the right approach for everyone. Think of solar here as a case study, not a recommendation. Purchasing a solar project can offer three primary benefits depending on the solar structure and your specific eligibility. The first one is investment tax credits, the second is depreciation, and the third one is the long-term income potential. But let's talk about investment tax credit. A tax credit is pretty much a dollar for dollar reduction in the amount of taxes you owe. It works pretty much like a gift card applied to your tax bills. For example, if you owe $1,000 in taxes and you have a $600 tax credit, your tax liability would be reduced to $400. So government used tax credits to incentivize certain behaviors, and in recent years, renewable energy has become a major focus of those incentives, which is the reason why solar has received significant attention in the tax code. And when I say solar, I really mean renewable energy as a whole. The next thing that a solar can give you is depreciation. What depreciation means is it reduces your taxable income, which can lower your overall tax burden. Let's say, for example, a tech executive in the Bay Area makes $2 million of income this year. And that translates to about $740K in federal taxes, assuming that they're at the 37% federal marginal tax rate. If you apply an $800K of depreciation, the taxable income would drop from $2 million to $1.2 million. And that directly translates to about $296K in federal tax savings. This is how depreciation work. The third one that about these renewable energy projects is they provide an income stream. Solar projects often include long-term income streams, commonly between 20 to 30 years. And it's really tied to the energy production of the solar project. The returns of the project vary based on the project location, the energy pricing, and the solar structure that you're in. In many cases, the projected cash flow is pretty modest relative to the tax incentives, and it's often in a range of low single-digit percentages annual. So don't count on it, is what I'm trying to say. In talking about solar tax strategies, there are a few solar structures that people should learn about. And the first structure is flip partnerships. A flip partnership is a structure where a solar purchaser and a solar developer form a partnership jointly to jointly own a project. The name comes from how the ownership flips over time. In a typical structure, the purchaser contributes the capital into the project, and the developer contributes debt and operational expense. So during the first 5 to 6 years, the purchaser may hold a large majority of the interest, which allows them to receive most of the tax benefits. And after the tax incentives are vested, the ownership flips and the developer becomes the majority owner, where they receive most of the cash flow. Another popular solar structure is called sales leasebacks. In a sales leaseback, the purchaser buys the solar system and leases it back to the developer. The developer operates and maintains the system while the purchaser receives the tax incentives, the lease payments that create predictable cash flow. And typically, who this is often suited for are individuals seeking steady income with lower operational involvement. The third popular structure is solar asset purchases. In an asset purchase, the purchaser buys the system outright, and they become the sole owner of the system. This allows full access to tax incentives and income, but also requires assuming the full responsibility for the ownership and the administration of the project. Typically, the purchaser will subcontract a third-party operator to do the O&M. This is often suitable for people who are comfortable with owning a system and the responsibility and long-term control of the system. The solar tax strategy is good, but it also requires understanding the risks and the limitations associated with the strategy. It comes with some constraints. And the first one is that to apply for solar tax benefit against active income, IRS rules generally require material participation. This typically means that participating in the solar business in a regular, continuous, and substantial way. But the problem is that the IRS has not precisely defined which activities qualify. So this is an area where coordination with qualified tax professional is essential to get updates as it goes. But for now, we do have a way for our clients to track hours on our platform, and we have strategies that's implemented to do so. Another risk to consider before thinking about a solar project for tax strategy is the project and developer risk. To qualify for the tax incentives, projects must reach mechanical completion and be placed in service in the relevant tax year. So projects must remain operational for at least 5 years and 1 day to avoid recapture. And so the developer experience and the execution does matter. It is extremely important to work with the developer that can deliver the project, and we constantly vet the developers to make sure that they're good before referring them to our clients. There's also some limits on depreciation and tax credits for W-2 earners. For W-2 earners, depreciation may be subject to annual limits under excess business loss rules with unused amounts carried forward. This is pretty significant. For single taxpayers, it's about $600K. For married, filing jointly, it's about $600K. The tax credits are typically limited to a percentage of the remaining federal tax liability, with the unused credits carried forward for many years. So now you learned about the tax strategy. Let's look at an illustrative example. Let's say you have an executive earning $3 million in a given year, facing about $1.5 million in combined federal and California state taxes. By allocating $600K to a properly structured solar flip partnership can result in a combination of tax credits, depreciation, and modest cash flow that reduces taxes significantly over time. And so let's say if they put $600K into the project, they have up to $858K of savings in year one. Due to the solar purchase. The tax bill on a $3 million income will come down from $1.5 million to about $650K in year one. That's a total reduction in federal and state taxes of up to $858K in year one, or 143.1% of the $600K purchase amount. You can see that here, she's got $475K in federal tax credit in the first year, or 79.2% of the purchase amount. And then on the federal depreciation level, she has $351,000 in tax savings, or 58.6% of the purchase amount. So 100% of this depreciation credit is available in year one, and federal depreciation saving calculations are based on a highest federal marginal tax rate of 37%. On a state level, the depreciation is $158K in tax savings, or 26.3% of the purchase amount. And up to 20% of this depreciation credit is available in year one, and the remainder will be spread over the following 5 years. The state depreciation saving calculation are based on the highest state marginal tax rate of 13.3%. And so this shows the year-by-year savings. You can see that it also shows a slight income of $6,000 per year from the energy production. So in summary, solar comes with a lot of tax benefits if you are in the right structure and the right type of setup. And it's typically suitable if you earn high income from W-2 wages, business profits, 1099 earnings, or capital gains. Or if you have significant upfront federal tax, it offers significant upfront federal tax credit, typically around 30%. And it gives you a dollar for dollar reduction on the taxes you owe. It can create potential income stream, typically 1 to 5% of the initial contribution per year for the project's duration, though the cash flow part is not guaranteed. The risk, for the most part, is that you need to show at least 100 hours a year to your solar business for each year you claim the tax benefits. And it also depends on the experience and the execution of the project developers. So that's pretty much it. If you have any questions, the key takeaway is that most people have an income plan, most people have an investment plan, and very few people have a coordinated tax plan. So solar is just one example of how tax incentives can work and when strategy modeling and structure align. So at WellQuant, our role is to help people understand how all the pieces fit together and to coordinate with licensed professionals to make sure that the decisions are made intentionally and are executed properly. So if this session raised questions about how solar or other tax strategies might fit into your broader financial picture, the next step is simply just book a call with us. We offer educational strategy calls where we review your specific situation, and we model the scenarios for you. And we help you determine whether further evaluation with licensed professionals makes sense. So thank you for spending your time with us, and book a call with us if interested.